Hello. As you may have watched the first part of the forecasting video, right? So we have seen how we need EFN, external financing needed um, to support the increase in assets as a consequence of the higher revenues projections that we make or we target. Okay, so in the second part of forecasting topic today, uh, we want to go further into setting some assumptions more realistic uh, because let me share screen. Okay, so what we have seen yesterday, and I will repeat a bit. Okay, and we will use a similar example, but not exactly the same. So please look at the new example set that we have on this video instead of the previous one. So yesterday's series on forecasting uh, was talking about the increasing revenues projections, right, for the subsequent years, maybe next year, maybe for years to come, right? So the increase in revenues that we want to achieve or target consequently will require the increase in assets, at least the spontaneous assets or the spontaneous type of assets, at least, but most likely all other types of assets will follow suit. So the increase in assets, uh, again, the increase in assets needs to be financed, and we hope that we could finance internally, right, to get some financing help from the natural increase in the liabilities, at least the spontaneous one. Spontaneous liabilities could increase and help to support the increase in assets. And also the second one, the natural increase in our equity, which is the retained earnings, right? The additional retained earnings that we could get from the operations, right? From the undistributed part of our net income in that particular year. However, if these two internal, natural, internal financing sources are not sufficient, then we will need an EFN, right? We have seen in the first video, right? If you haven't watched the first part of the video, please do so because this is a continuation, assuming that you have comprehended the basic uh, characteristics and also knowledge and materials on the forecasting. So we'll need an EFN once again if the internal financing such as this, right? Uh, the increase in spontaneous liabilities and then additional retained earnings are not sufficient to support the increase in assets that we need because of the increasing revenues projections that we make. Okay, now EFN could be uh, financed using debt, right? Additional debt financing. You could also, of course, issue new equity. However, the second one would be uh, quite rare, right? Quite infrequent because, again, the uh, considerations that we need to make, right, to take into account when issuing new equity is certainly more complicated than that of like issuing or borrowing more money, right, or issuing new debts. Okay, so most of the time, the EFN will predominantly be financed with debt, right? Okay, so here's the difference now. In the previous video, uh, we we didn't make like complicated situation in the real world, so we just assumed that if we need new debt stemming from the requirement of EFN, then it would not affect the, for example, the interest expense and other pertaining items. So we just assume that they would be like static, right? They would not be affected by our current decision to increase the debt, right? So you see, so in the first part of the forecasting topic in our first video, we just simply uh, said that we would need a certain amount of money from debt to finance the EFN or as the EFN, but that wouldn't affect the the existing interest expense and also the new interest charge that would be levied because of the uh, new debt financing or new debt decision. Okay, here's the reality, right? So today's video about the second part of the forecasting will deal with a real world situation where many related things are not static but they are dynamic. So they will change, right? They will respond to our new decision to employ higher debt level, right? So let's imagine again the situation. If we need an EFN, right? So this will predominantly be financed with debt, right? Of course, we could finance with new equity as well, but that's quite unlikely, especially if uh, we need it in a short period of time, or we don't really need a significant amount of money to support the increase in assets. But again, most likely this will be financed with debt. So the need for additional or new debts will require higher interest charge, right? And remember, we already had the existing interest expense, right? The what's that? The existing debts, the outgoing bonds and other borrowings that we are having right now. But we also have now, if we want to borrow a new level of debt, and that might increase the our debt ratio, then most likely the interest charge will increase as well. So we have to pay like additional interest expense, maybe a higher interest charge. And you can imagine the situation now. The higher interest expense or higher interest charge will lower our net income, right? Okay. And when the net income is lower, then uh, one of the direct effect would be on the retained earnings, right? So lower amount of net income, of course, will affect the availability of retained earnings. So most likely retained earnings will be lower as well. So now if the retained earnings is lower, now it will create a cycle. Can you imagine, right? So the debt financing for EFN will increase, right? And if there's an increase for debt financing as EFN, then we'll go back here, right? The higher interest rate, higher interest expense, lower net income, then lower retained earning. So the additional need for EFN, finance with debt, and then higher interest expense and so forth. So this will create an unending cycle. So this is something that we didn't focus on in the previous video. Something that we are going to talk about and try to solve, right, in this video. Okay, so this again the background or uh, again the introductory situation for us to discuss the forecasting, especially how to reconcile the situation where actually the cycle could be could be spiraling forever because of the again the unending cycle that we have just seen. Okay, so let's go straight into our example to make it clearer. So you see the Excel now, Excel. So we're using a hypothetical company that we made up, right? Grace and Tooth Company. So some of the items, or many of the items, are similar to the one that we saw in the previous video, but not all of them. So please bear with me. So we'll see the 2020 income statement. So we assume that this is the uh, the past information, like the information that we already had. So it's a ex post information, something that we already had. So revenues were 1 billion. So we use like in thousand, okay? So we write 1 million here, but actually 1 billion. Okay, the cost of goods sold is 620 million. So again, we don't use the percent of sales method to estimate the cost of goods sold, but we are using the regression equation. Right? This is just another style. Many companies will choose to use the percent of sales method because it's more straightforward and also easier to estimate, especially for a long projection, right? Projections for many years. But again, we are using the regression equation, 120,000 plus 0.5 times sales or times revenues. So we get this number. And then gross profit, right? Sales minus cost of sales. Now we have operating expenses. So again, because we are not focusing on the accounting accuracy and items, we just combine the indirect operating expenses as one, and it even includes the depreciation and amortization expenses. So we'll just combine it to one again because we're not focusing on the again accounting items. And again, we don't employ the percent of sales method, but we are using the regression equation, right? Minus 120,000 plus 0.3174 times revenues. So we get this much. And then the EBIT, again, we assume there's no other income or loss items. So the operating profit is also the EBIT in our example, right? Simple example here. And then the interest expense, this is the existing one, okay? So we see, give a asterisk here. So let's check. So interest charge on long-term debt is 10%. So let's check our current balance sheet in 2020. The long-term debt is 480,000. Right, so 10% of it is 48,000. And then short-term debt, let's check what short-term debt that bears interest. Uh, these are our short-term debts, short-term liabilities, and only this one, only notes payable bears interest charge. So 120,000. Again, I think we are not going to discuss too much about the accounting items, but accounts payable and accruals are not interest bearing, right? So they are our accounts, they are our current liabilities, but they are not interest bearing. So only notes payable is interest bearing. So 120,000, 8% is the charge. 8% of 120,000 is 9,600 or 9.6 million in the real number. So the total is 57.6 million. Again, this is in thousand, okay? So 57.6 million, the existing interest expense. And we could count the EBT, earnings before tax, or in the US would be taxes. Right? They have federal and state taxes. And then the tax rate is 4%, 40%, right? 40% of 125 million. And then the net income is 75 million. Then the information tells us that the dividend payout ratio is 40%. So dividend amount in the previous period or in the existing period was 30 million. And of course, out of the 75 million, when you distributed 30 million, then you have the remaining 45 million to be saved or retained. So this is the addition to retained earnings, right? 45 million. Okay, so that's our current situation. And then we'll see our balance sheet, our current balance sheet. Okay, so the current one, year 2020. So cash, now we are using the percent of sales method, right? So sales is 10% of revenues. So 10% of the current revenues of 1 billion. Right? 10% of 1 billion is 100 million. Right? 4.17% of 1 billion is 41.6 million, and so forth, right? So these are these ratios are using the percent of sales method. Okay, so the four assets, right? Four spontaneous assets, because they move, they increase along with the revenues, right? So they increase with the increase in revenues as well. Okay, so current assets and the fixed assets, here we see the net fixed assets, net. So they have deducted their accumulated depreciation. Okay, and then we have the total assets. So accounts payable and accruals are spontaneous. So they increase together, or they increase along with the revenues, with the increase in revenues. So 5% of revenues, 2% of revenues, respectively. Okay, so 50 million and 20 million each. The notes payable. Now, notes payable is not spontaneous. So uh, again, in the first part of the video, we have discussed the easiest way to differentiate the spontaneous and non-spontaneous part. So non-spontaneous items would be more, you could say more, you know, easy or flexible to be decided, right? Whereas the non-spontaneous items would require more thought, right? More considerations, maybe more meetings, something like that, right? So just put it this way, right? If you want to issue a series of notes payable or a series of bonds payable, then of course you will estimate, will calculate them carefully, right? So notes payable is not spontaneous. Then we get the current liabilities, right? These three items combined, we get the current liabilities. And then long-term debt is certainly not spontaneous. And then common stock is, of course, not spontaneous. Then we have the existing retained earnings, existing amount of retained earnings. Okay, this is the information that we have, the existing information. So we suppose this was the ex post information uh, that we already had. So now we start making a projection, right? And in this example, we only make a projection for 1 year, so the next period, the next year. Okay, let's see now. So here's the principle. Again, this is different from our analysis in the first video, right? Uh, Again, in the previous video, we didn't take into account the fact that the requirement for debt financing as EFN will render the interest expense or interest charge uh, increasing, right? So in the previous video, we just assumed that the interest expense would not be affected, so we could reconcile the projected income statement and balance sheet easily. But today we see a complication because of the fact that uh, that we might have an unending cycle because of the increasing interest expense. Uh, Again, would engender lower net income, and that would create a situation where the retained earnings will be lower, and will need and subsequently will need more debt as EFN. And then the more debt for EFN would increase the interest expense again, and so forth. Okay, so here's the principle when we want to make the reconciliation, right? we want to reconcile the income statement and balance sheet under that situation. So here's the principle. So fill up all items for projections up to the operating profit or EBIT. So see the story here. So the information or the forecast, or the forecasters, our research division, or some the accounting people in the company are telling us that the projection says that sales is targeted to increase by 20%, right, next year. Right? And the dividend payout ratio will remain at 40%. So let's fill it up, right? So from 1 billion, it will increase by 20%. So it's targeted to increase by 20%. So it will become 1.2 billion, right? Again, this is in thousand, right? 1.2 billion. And the cost of goods sold will follow the regression coefficient. And this was probably, the research was probably conducted by our internal researchers or our internal accountants, and they produced this regression equation, right? 120,000 plus half times revenues. So we get a projection of 720 million. So the gross profit will be 480 million. And the same thing here, operating expenses. So we just combine all indirect operating expenses into one big item. Yeah. And of course, in real life, you want to break them down, right, one by one. But again, we are not focusing on the accounting items for now. And operating expenses, including depreciation and could be amortization as well. Depreciation expenses included. So minus 120,000 plus 0.3174 times revenues. So we'll get a projection of 260 million. And then the EBIT, right, we'll get 219, the gross profit minus the operating expenses. Okay, so we'll stop here because we couldn't continue without reconciling the interest expense. Right, reconcile the interest expense here. So we'll stop here. And of course, we simplify things. Once again, we simplify things that are not the focus on our discussion right now. For example, the depreciation expense. Again, the first video, I also talked about this, that in real life, depreciation expense is probably one of the most complicated items that we have to break down and estimate in accounting and finance, because we have the depreciation and amortization expenses on the existing assets, existing capital assets, and then we have the depreciation expense on the new assets, like new fixed assets, and also depreciation expense on the regular capex, right? On the the simultaneous, right, or spontaneous capital expenditures, maybe certain percentage point of sales every year. So you see, at least we have three items for depreciation expense, right? The existing assets, the new assets, and also the spontaneous capital expenditure. So things are quite complicated, but we simplify it because we are not focusing on depreciation expense accounting at this time, right? And also, if you follow the construction industry, like construction sector, we might have the interest during construction that could be depreciated as well. And there are many other real world accounting complicated things that we are not focusing right now. So okay, so coming back to our story here, we stopped at EBIT right now because we couldn't continue without reconciling interest expense and so forth, right? So we stop here. What about the projected balance sheet? Let's see, now year 2021. So cash, right? We follow the percent of sales method at 10% of the new revenues. So new revenues are 1.2 billion. So 10% of 1.2 billion is 120 million, and so forth, right? The 4.17% of 1.2 billion is 50 million. and so forth. So we are using the percent of sales method for this spontaneous assets or spontaneous current assets. Okay. And again, I'm reminding you that in the real life, we have to check one by one, and we cannot just assume, right? Once again, we can't just assume that any items could be automatically identified as spontaneous or non-spontaneous. So we have to check one by one, right? For example, marketable securities. In our example here, I include marketable securities as spontaneous current assets, but in real life it might not, right? It might not be spontaneous because maybe you're making a deliberate decision on the marketable securities that you want to hold, right? Accounts receivable, inventories, prepaid expenses, and other things. So you have to decide one by one, right? But in this example, I assume, or I make this assumption that these four are spontaneous. Then we get the current assets, projected current assets for 2021. And here is another example of simplification. Okay, so the net fixed assets, again, fixed assets minus their accumulated depreciation. So I assume that it doesn't change. And of course, in real life, it might increase, it might decrease, right, from time to time. You might buy more assets as a consequence of the increasing revenues projections that you want to pursue, or maybe you are decreasing because you have like a lot of room for maneuver or idle capacity, right? So I'm assuming that this doesn't change. Okay, again, we are not focusing on that, right? So total assets will be 1.8 billion. Okay, now the financing side, accounts payable and accruals are spontaneous, so they follow the increase in revenues. So 5% of the new revenues, again, the new revenues are 1.2 billion. So we got 60 million here, and then 24 million for accruals, projected accruals in 2021. Now, notes payable, again, is not spontaneous, and I assume that the amount remains the same. Again, in real life, this might increase. You might issue now new series of notes, or maybe you have now new bonds payable, right? Or maybe you pay off some outgoing notes payable. So this might decrease or anything. But again, in our example, I assume that they don't change, right? They remain. It remains the same as the as that in the previous period. And current liabilities, these three items, right? Current liabilities, long-term debt is non-spontaneous. And again, I assume that the amount remains the same. Of course, in real life, this will definitely change. You might have paid off some principal of your debts, right? Or you increase more debts from banks or from other sources, right? And you have common stock. We assume that you don't add any common stock or decrease any common stock, right? No stock repurchases either. And then we'll stop here, right? Because we cannot continue without reconciling. So again, one more time for the income statement, we'll stop at EBIT for now. For the balance sheet, we'll stop at here. So the subsequent items like retained earnings cannot be determined without reconciling the income statement and the balance sheet. Okay, so up three is quite clear up to this point. Okay, so now let's see the reconciliation, right? So again, in the first video, we didn't need this kind of reconciliation because we just assumed that the requirement for EFN will not affect, although we are using heavy additional debt financing to finance the EFN, we will not the decision will not affect the existing interest expense and so forth or other pertaining items. But now we see the fact that everything might change, especially the interest charge. Okay, so this is the reconciliation that we have to conduct. Right? So we have to determine the EFN that will stop the cycle, right? To stop the unending cycle. So once again, so I'm repeating this over and over again, right? So see, if the EFN is positive, meaning that we need external funds, right? Additional funds, right? And this would predominantly be using debt, right? Debt financing is more likely or most likely, right? And if we need more debt, then the interest expense will increase, and the interest charge will also change, right? Will also increase because now the company is considered riskier with a higher debt ratio, right? So the increase in interest expense would affect the amount of net income or projected net income. So obviously it will be lower, and the lower net income will again will render the retained earnings lower as well. Okay, so lower retained earnings mean that the ability of equity to support EFN will be lower. So we now we need more debt financing even, right? And again, now the more debt financing will require higher interest expense or higher interest charge and so forth. So this is an unending cycle, right? So to stop the cycle, we have to do this reconciliation, okay? So we have to estimate the EFN, the external funds needed that could reconcile the projected income statement and the pro forma balance sheet. Okay, so this is a formula here that I have summarized for you. This is the numerator. You see the line there. These are the numerator, the components in the numerator, and these are the components for the denominator. Right. So we start from pro forma assets. Right. Pro forma assets is the projected assets. So we'll check. Projected assets in 2021 is 1.8 billion. Okay, 1.8 billion, you see here. Okay, minus beginning retained earnings. Beginning, right? Beginning. So this would be in 2020, beginning. Retained earnings were this one, right? For 2020, retained earnings were 560 million. Yeah, 560 million. Minus pro forma or projected total debt and common stock. This is the projected one, right? Projected total debt and common stock. So you see the balance sheet for 2021 for the projected one. So total debt. So this is the component for current liabilities, right? Current liabilities plus long-term debt plus common stock, right? Total debt and stock. So again, one more time here, current liabilities, long-term liabilities, and common stock. So the amount, the total here is 1 billion something, right? 1 billion. I will check. Correct, right? 1 billion. You see here, 1 billion. So the projected total debt and common stock, 1 billion. Right? Minus, in brackets, right? In brackets, forecasted EBIT minus interest on existing debt, right? Forecasting EBIT. So we'll see the projected income statement. So income statement for 2021, projected EBIT is 219 million. Okay, minus interest on existing debt. Okay, interest on existing debt. So the existing income statement, you see here, the existing interest expense is 47.6 million. So again, the forecasted EBIT is 290 million minus the interest expense on existing debt. Existing, right? So it has existed, not the new one. So 57 million, 57.6 million. Okay, so we get this amount, 161 million. Okay? Multiplied by 1 minus tax rate. So our tax rate is 40%, right? 1 minus 40% is 60%. Multiplied by 1 minus dividend payout ratio. And you see our story here, the dividend payout ratio will remain at 40%, right? So 1 minus 40% is 60%. So this is a retention rate, right? 1 minus dividend payout ratio, or the ratio of retention, right? Retention rate of the company. So I would just want to remind you that we have to be careful with mathematical execution. So it's multiplication here. See, multiplication has a higher priority over the subtraction. Okay, so be careful to multiply these items first, because a multiplication has a higher rank or priority over subtraction. Okay, what about the denominator? Denominator, so 1 minus PD. PD is the proportion of EFN finance with debt. So of course, our company will make our own decision, but you see the information here. So the board of directors decision is to use should they need EFN, they will finance all of the EFN with debt, 100%. You see the board decision here. So we suppose there's such board decision. So again, if or should they need EFN, they will finance the EFN entirely with debt, right? So 100% debt financing for EFN. Right? So the PD is 100%, right? Proportion of EFN finance with debt, multiplied by I. I is the interest rate on new debt. So let's see the information that we got. Interest on new debt is 11%. So it changes, right? It changes compared to the existing debt, right? So now the interest on new debt is 11%. Okay, so I here is 11%. Right? So multiplied by 1 minus tax rate. Again, the tax rate is 40%. So this is 60, right? And multiplied by 1 minus dividend payout ratio. Again, the dividend payout ratio is dividend payout ratio will remain at 40%. Right? So 1 minus 40% is 60%. Right? And again, be careful. See multiplication first, right? Before subtraction. Okay, so using all the by again employing all the numbers, right? The uh, all the numbers that we have checked. So we get this. This is the numerator. This is the denominator, right? And the resulting EFN is 195.6 million. Again, this is in thousand. Right? So the EFN that could reconcile the income statement and the balance sheet under this dynamic scenario is 196.6 million. Right? So by estimating the reconciled EFN, then we could continue, right? We could proceed with the projected income statement. Remember the last time we stopped at here. We stopped at EBIT because we couldn't continue. Now by knowing all the information, right? We reconcile EFN at 196.6 million, and this would be entirely financed with debt, right? 100% financed with debt, new debt. So we'll continue here. We stopped at EBIT before. Now we could continue. Now interest expense now has two components. The existing one, see, in 2020 we paid 57.6 million, and of course, when you make a projection, this might change as well. We are not saying that this would be constant, but if this has to change because maybe now your debt principal has decreased and so will your interest expense, then you have to adjust the amount here as well, right? You see, remember our one of the items there, one of the components, right? Forecasted EBIT minus interest on existing debt. So if your existing debt will have to pay like a lower interest expense or a higher interest expense, that should be reflected here, right? Reflected in this item. But in our example, we assume that we will continuously pay this amount, right? 57.6 million, continuing from the previous period, right? 57.6 million. However, now we have the second item, which is the new interest expense or interest expense on new debt. Remember, the new debt would be would amount to this much, right? New debt 196.6 million, right? And then the new interest charge is 11%. Okay, so this would be what? 11%, 11% times the new debt that we are going to borrow or issue, right? So again, 11% is the interest charge on new debt, and our new debt is the entire EFN, right? 196.6 million. And we will get 21.5 million. When we combine them, we add them together, we get the total interest expense for the projected year. Okay, so 79.1 million is the combined interest expense, both existing and new. Okay, so by knowing or by estimating the interest expenses, right, both right, interest expenses, so into one interest expense, we could continue with EBT, again, the EBIT minus interest expense. So we have EBT, and then the tax rate is 40%, right? 40% of this is 56 million. Then we have a projected net income of 84 million. Okay, and from the information that we had, again, dividend payout ratio will remain at 40%. So 40% of the net income, 40% of the projected net income is 33.6 million. So of course, this year, for the next period, for next year, we project or we forecast that there will be an addition to retained earnings of 50.4 million. Okay, so again, the projection comes from again the retention ratio, because we plan to pay out 40% from 40% of net income as dividends, or maybe stock repurchases or something else. But again, the distribution to shareholders is 40%. Now the addition to retained earnings is 50.4 million for next period, for next year. And then having the information on additional retained earnings, we could continue to reconcile our balance sheet. Last time we stopped here, remember? We stopped, see here, we stopped at common stock, and we have the question marks here that we could not fill up because of the reconciliation problem. Now we could reconcile because we had this information, right? The additional retained earnings for next period. So we stopped at common stock. Now we have this information, retained earnings. So existing retained earnings were this one in 2020. It was they were 560 million. So and then the projected retained earnings for 2021 was 50.4 million. So we could add them together, right? We add them. So 560 million were the existing retained earnings, and 50.4 is the projected additional retained earnings from 2021. So we project, or we forecast that in 2021, the amount of retained earnings will be 610.4 million. And of course, by having this item, now we could recalculate or we estimate everything. This is current liabilities plus long-term debt, right? The existing one, 480 million. And we make again a simplified assumption that the existing debt doesn't change. So throughout the year, we will not add more debt, nor will we pay off some principal of the debt. So it will remain as it is, right? As debt in the previous period. However, in real life, this might change as well. Okay, in real situation, we can figure out by ourselves. And now we have again we have new long-term debt for the EFN, because we require again the EFN from the reconciliation process, we need an EFN of 196.6 million, and this will entirely be funded with debt. Okay, so the existing debt that is assumed to be not changing, right? It remains the same, and then the new debt. So the entire EFN will be financed by our finance with debt, 196.6 million, plus common stock that doesn't change compared to the previous period, plus the new or the accumulated retained earnings projected for 2021. Right, the existing were 560, and the projected additional retained earnings are 50.4 million. So the cumulative amount is projected to be 610 million. And then we add all of this together and we find this exactly matches the projected assets, right? 1.8 billion. Now we have a balance, very nice and balanced balance sheet, right? That's why we call it balance sheet. They should balance, right? The investing side and the financing side. Okay, so this is the reconciliation again that we require in real life, because the decision to add more debt to support SEF and to support the increase in assets as a consequence of increasing revenues projections will require the reconciliation, right? So we need the EFN reconciliation that we just saw and we just did, right? And then we could reconcile, afterward, we could reconcile our income statement and balance sheet for the next periods, or for many periods to come, right? Then we could do it. Okay, I think that's all for this session. This is a continuation of the forecasting topic. It's very important again for as a backbone for business valuation, because by making the projections, we could continue with estimating the free cash flows to the firm, and or the free cash flow to equity holders and all other modifications, including the estimation of horizon value, right, or terminal value. Okay, so thank you very much for watching this video. I'll see you again in other interesting topics. So stay tuned. Thank you.